Have you wondered what financial advisors actually think about finances? This is your sneak peek at the conversations within Financial Design Studio. Michelle Smallenberger, the CEO here, will be your host as you go behind the designs.
All right, welcome to Behind the Designs. My name is Michelle, and I'll be your host today. With the seasons changing, there's a lot of changes happening with the financial world as well. In the last episode, we talked with Heather Walzer, an estate planning attorney, about what's happening in the legal field. And today we want to focus on the lending industry. So please join me in welcoming Tom Cramer back to the mic. Welcome back, Tom.
Thank you, Michelle. Nice to be back. Thank you for inviting me.
Yes, always great to have you. Tom is a mortgage officer with Wintrust, and he's been doing this mortgage and lending for 27 years, so a lot of wisdom and experience here. We first had Tom in episode 27. In this episode, we talked about the state of mortgages at the time of their recording, which was basically a year ago. But as time goes on, things change, and we want to hear from you again about the hot topics and things that you're seeing now. So it's been a year. Why don't you just kind of give us kind of a broad picture of what you're seeing now, what changes you've seen in that time frame?
Sure. We came off of a really busy time in 2019, 20, and 21, basically, and then when mortgage rates jumped up from the nice low 3%, 2.5%, 3% up to over doubled, right? We got over 8%. And nobody wants to get rid of their interest rates, so they don't want to sell their houses because they got these nice low interest rates. So it caused a housing shortage. And so this past couple of years has really been a struggle in our industry. We didn't have refinances, and we have a bunch of, I have 40 people in my pre-approval pipeline right now that are trying to find a house, but just when a house comes on the market, there's a lot of competition, and they're getting beat up by just crazy over asking price offers or a lot of cash offers. And so now that rates have actually come down it's to around in the mid sixes, it's kind of spurred up some activity for us, and definitely the refinancing. So if you've purchased a house in the last 15 months, you need to really take a look at your mortgage with your mortgage professional and take a look at what today's rates would mean to you. Yeah, so we are seeing a lot more activity, and it's seeing a little more come on the market right now. So
like more homes even for sale, people probably wanting to move at these rates. It's low enough that they're willing to move.
Yeah, I think once we get definitely in the fives, maybe we'll see even more. But and there's reasons why people have to move too. They get a job, they get divorced, or they or want to retire, and so there's still the reasons but there's also kind of a shortage on new homes too. So hopefully we start to see some more houses come on the market.
Yeah, no, it's helpful to hear kind of what you experienced even. I think it makes sense that, when we talked a year ago, I think you were saying rates were at like 8% then. Now we're in the mid to low sixes. And so even in that time frame, I think we expected that there would be less homes for sale, less people wanting to buy a home, because if you had that low rate, like you just said, locking in a higher rate is not going to be exciting. All right. Well, with that update kind of as our backdrop, and you even kind of mentioned something, refinancing, I think that's probably one of the biggest questions that people have if they have purchased in the last 15 months. And they, like you said, there's people that still had to move, whether it was due to job or whatever the reason. And so there were people that got higher interest rates. So one of the biggest questions I think people have is, when should I refinance? What would you say to that?
Yeah, I get that question all the time, and it's really matters on how large is your mortgage, because if you took out a $50,000 mortgage, the rates dropping 2% doesn't make a big change, because the closing cost on a mortgage on a refinance is still the same amount no matter what the loan amount is, basically somewhere around $3,000, I would say. So you really have to look at what your monthly savings is versus the cost of refinancing. And so and when it looks like there's possibility of rates going down further, is it good to wait? I get this all the time. I want to wait till after the election, see what the election does, or the rates are going to come down further. Well, why not bring it down now? If I could give you a rate that has a credit that covers most of your closing costs. A lot of times I'm getting property inspection waivers where I don't need an appraisal. So that means I don't have to collect any money up front from a client. And then we could refinance them, cover their costs. They actually end up skipping a mortgage payment. So why not save the money that you can now? And then if rates drop further, then I'd be reaching back out to you to refinance again. There is no maximum amount of time or minimum time you could wait. So
that's helpful, because I think that is one of the questions that, we even think of and that clients have is, is there a number of times, a maximum number of times you can refinance, which, like you're saying, there isn't. One question, one thing I did think of in this is, could it possibly hurt you if you refinance? Let's say you refinance today, you were at 8%, now you're in the mid sixes. And then again in 3 months, 2 months, you refinance again because rates drop. Could your credit score affect the rate or anything like that? So could you be hurt at all by refinancing multiple times?
That's a good question that I can't honestly answer on what the effect in the FICO score does. New credit normally does affect this credit score to go down a little bit, but I don't know on mortgages, to be honest with you, if it changes that much. But you got to be careful of making the payments on time. When people refinance, sometimes they get confused, like, I didn't need to make that mortgage payment because my loan's getting paid off. But the timing of it all might have not gotten paid in time for that mortgage payment that was due. And so I've had people get reported late on their mortgage where they thought, well, the refinance was taking care of that. So there is that chance. But
okay. So, and I think this is one kind of theme we'll touch on a lot is be communicating with your loan servicer, with your mortgage lender, so that you know what needs done, what's next. So I think that's helpful for people, and even helpful that you kind of touched on. Nobody knows what tomorrow is going to bring. Nobody knows what, what event happens that we think rates will keep doing this, but we never know that for sure. So I think your point is really helpful that if you can lower that payment now, do it. And if they go down lower, refinance again. So it's helpful.
And while we're talking about credit scores, if you know you're going to refinance or get a mortgage, you want to make sure your revolving credit lines that you don't have balances, you're not carrying balances over 50% of the line limit, because that's going to affect your credit score. So you could be paying everything on time, but if you're overutilizing your revolving credit, it's going to affect your score. And nowadays, they've gone up to 780. You want to have a 780 credit score to get the best interest rate. Fannie Mae and Freddie Mac have loan level price adjusters for different FICO scores, and if it's your primary residence or your second home, your loan to value, so to be in the best rate environment, you want to make sure that you go into it with a 780 credit score.
Okay, so let's say someone today is kind of over that 50% credit utilization, but they paid off a bunch of debt, like they're just getting ready to, or they just did. How long should they probably wait to actually see that impacted on their FICO score? Do you know, is it like a month, 30 days, 60 days?
It's almost instantly. Actually, one of my services I provide is I review the credit, and I have what's called a what if simulator that I use. And so I could play with borrowers' balances, and it tells me, what the possible FICO score could be. And then I instruct my borrowers what to pay down and how much to pay. And then I could get a credit supplement and rescore. And that's done within a week. And the scores actually drop down. So.
Okay, that's great. So it's almost being recalculated kind of on your side by the underwriter, kind of in that underwriting process.
So it's actually, it's not Wintrust. It's not any mortgage lender that's figure in the FICO scores. It's actually the credit bureaus and the credit company that we use for a tri-merge credit report. They're the ones that go and do the credit supplement and rescore. So it's not the lender doing it; it's the credit company.
That's helpful. And I know a lot of these, there's like so many details on a lot of these pieces. So we're going to try and talk big and broad in a lot of these topics. But where there's questions, I think this is helpful for people. So thank you. One of the big things is also, if I've purchased in the last 15 months, what if I'm looking to purchase a new house, not contingent with the minimum down? How can they do a principal reduction and recast the loan payments without the expense that a refinance would have? Is that possible?
Oh yeah, that's a great question. We have that all the time because right now, if you want to win your offer to that seller, you're going to want to do it with a non-contingent offer, meaning you don't need to sell your current home first. Because they're going to take that offer over someone that says, "Oh, I'll buy your house, but only if I could sell mine," because I need the money out of my house to put down towards your house. Well, you could put as low as 5% down on a conforming loan. So if you have that 5% in the bank, as long as you qualify for your existing mortgage and the new mortgage, then you're taking out a larger loan than what you want. But as soon as your current house sells, you could send in that money towards your new loan as a principal payment and ask the servicer to do a recast. And I know that at our company anyway, we could recast as long as it's over $10,000, and we could do it annually. Even you could do it multiple times, but it's got to be just once a year. But most of my clients, they'll send them money in. We'll recast it. It's a nominal fee. I think it's $150 or something, but it's much cheaper than refinancing. So unless for some reason you were up at 8% and then your house sells, and then it makes sense to refinance. But if you want to be at the current rate that you're at, the best thing to do is recast the loan. And even if you had private mortgage insurance, because you need to have 20% or more to down payment to avoid paying private mortgage insurance. So that mortgage insurance then would fall off after you've made the principal payment.
Okay. So talking about recasting mortgages, I don't know that a lot of people understand what that means, like to recast a mortgage. So let's talk about this in the instance of someone who says, I have a mortgage and I want to pay it off by the time that I'm retired. Great. And so they send in $50 extra to every payment, and that just gets applied to their principal, or it just gets applied to their mortgage. So that's just paying extra each month versus actually recasting the loan. Can you explain what that is versus just this extra payment?
Yeah. So they might be able to afford the new payment they're on, and then they're putting $100,000 as a principal reduction. What that's going to do, if you don't recast the loan, it's going to just pay off your loan a whole lot quicker. But if you recast it, what that means is you're then amortizing that new balance over a 30-year period. So it's bringing down your mortgage payment, but it's keeping your 30-year term or your 20-year term, whatever term you took out at the beginning. But if you're looking to aggressively, pay off your loan and you afford the payment, then I have had people just keep with the higher payment and they just pay off the loan quicker.
Yeah. So someone who initially got a 30-year mortgage, they're 10 years into it. So now they have 20 years left. They recast the loan. The purpose of recasting it is so that they're actually lowering the required payment that they have for the remainder of the loan, but it's still going to stay at the 20 years remaining for that loan.
Whatever their current term is, right? If you're recasting for longer than your current term, that's called a loan modification, and that could affect your credit score. Yeah, and we saw a lot of that when COVID hit. There was a lot of that going on.
And that makes sense because you're basically taking kind of wanting to lengthen the term of that mortgage. So that makes sense.
No, that's really it. And most people, they think that they have to refinance and go through that whole approval process, and you don't have to.
So really the benefit that they're getting even further is that if they were to lose their job or anything like that, they have a lower required monthly payment. So it could benefit them just again, because we don't know what tomorrow brings. So it's just another way to actually lock in the lower amount because you paid, kind of a big chunk down on your mortgage.
Right. Or take that savings and give it to Financial Design Studio to invest. And
exactly. Yeah. Yeah. You invest the difference. And that's where it's like, if those are savings, that becomes a question of what should I do with these funds? And you're right. These are things we look at every day with people to say, okay, well, here's the benefit. Here's what the numbers say. Now, what do you feel about this? What do you want to put it towards? Yes. No, that's great. Yeah. Okay. So kind of the last one on this topic here. What if I'm looking to get a mortgage for a second home? So people who, have a home, maybe have a mortgage, and then, or maybe even just, recently purchased one and now they're wanting to get a second home. Anything there that they need to be mindful of that we haven't touched on in this?
Sure. So second homes also have loan level pricing adjustments if you're above a 15-year term. And so if you're going to buy a second home, you do have to put more money down, so minimum of 10% down. At 10% down, the rate's going to be still ugly. So you want to at least have 20% down, 25 ideally, if you're looking at a term over 15 years. If you want a 15-year fix, then I don't believe that there's much change at all. If you own a home free and clear and you're buying that second home, then we would want to look at, well, what would it look like buying that second home cash and putting a mortgage on the primary house and doing a cash out to pay for the second home. And that goes for investment homes too, because that's even more of a risk. So the loan level pricing, that's figured based off of people's, that they'll pay their primary residences first. They'll pay the secondary residence second, and investments will be the last thing they pay. So it's just the whole risk and the mortgage and how they build the price the risk into the price.
Yep. So basically, because it's more risky, like you said, if it's not the primary, it's a second home or even investment property. Now in order to pay for that risk that the lender is taking to loan this money to you, you're basically going to have a higher rate to pay for that
Correct.
increased risk, right? Mm-hmm. Okay. No, that's really helpful. So I guess kind of switching gears a little bit. Again, now we have lower rates than we did have a year ago. What if I'm a first-time home buyer? And I think a lot of people kind of have been just sitting on the sidelines. Like you said, it is very competitive to get a house. Housing prices are higher. Right. So I think a lot of people have just said, you know what, we'll just keep saving our money. So when rates come down and when there's a better supply, we can actually be prepared for that. And I do think there's a lot of people kind of waiting for that. What should they know about buying their first home in this environment, or, things like that? Sure.
I'd simply advise that mortgage rates are unpredictable. That the timing of the mortgage with the market is there's no guarantee day by day that, next year is going to be lower rates. So if they have that house that they really love come on the market, then go for it, because you're really you're renting your rate, and, you're not stuck to that rate. So you want to buy that house that you like, get it now, because in the future the rates could be lower, but the house prices could be higher, which would put you at the same payment you're at right now. So
I think that's a really helpful point that you make. We kind of give such an emphasis to rates and where they're at today, and for good reason, because that does affect people's monthly payment in a really large way, depending on what those are. But I think one of the things that you talked about, like before, even before we started recording, was, so I'll let you touch on it again, is just that rates, might be higher or lower, but also housing prices, like that's assuming housing prices just stay the same as where they are. And so you just kind of said something like to this effect. So talk a little bit about that, is like the housing price versus the mortgage rate. Both of them move. So we can't just say, wait for one to change, because the other one could change too, right?
Right. Nobody's got that crystal ball and telling you exactly when the perfect time is. I don't know if there ever is a perfect time. So you just go into it knowing that you're always going to have your mortgage reviews and if save money down the road. But you definitely want to be able to afford what you're getting into. So you don't want to jump into if the rates are higher now but you're approved for a certain price home, and then now the rates are higher. Yeah, you're approved for a little less of a loan, but you don't want to jump in there and be house poor, or not be able to go out to dinner. So yeah, every individual is going to have something different. I mean, there's a lot of bond programs out there. There's a lot of grants that we're giving. There's a whole lot more than last year than what we talked about. So I literally have to go to my chart of different loan programs and different down payment, and some require to be under 50% of the area median income. Some are at 80%. IDA still, Illinois Housing Development Authorities, they still have where you can make more money than the rest, but the forgivable loans is over a certain period of time. The grants that I've been dealing with right now are forgivable right at closing. So if you sell your house or refinance within a couple months, you're not having to pay back that down payment assistance that you were given. So I would take advantage now. Any young person out there now or don't need to be young, I'm sorry, first-time home buyers. I recently could think of a lady that I was renting an apartment, and the rents are going crazy right now. And I was able to close her with 3% down and was able to give her $12,000 worth of grant money, which I think her total out of pocket was was 1% of the purchase price, and her monthly payment is lower than her mortgage or than her rent would have been. So she never had to be out any extra money out of pocket because the money that she had to put into the transaction was as much as her rent was. So, and when you close on a mortgage, you generally are paying a month after that. So there was really no change in her monthly financial situation. So.
Yeah, that's the thing that's so interesting, is that rates, housing prices, your current situation, if it's rent, like all of those things can be changing. So it is, the nice thing with a mortgage rate is you can lock that in when you know what it is. So we know they've gone from 8 to 6.5. So we can lock that in. And if they even decrease further, you can lock that in. You may or may not be able to lock in a price, because depends on what the competition looks like for that specific home. So I think that's interesting and really helpful just for people to even realize all of the moving pieces. And so, do what you can, but also just be asking what's possible too. So I think that's really helpful. All right. For, I guess, another situation I kind of think of is, with rates where they are today and maybe where they're going, a question we get is, I'm a retiree, can I get a mortgage even if I don't have income?
Yeah, great question. Yeah, so they do have income. I mean, you have Social Security income. If they might have a pension. They might have an IRA that they take So when I talk to retirees, I like to work with what payment do they want to have? And then we kind of figure out from there how much of a mortgage that would equal. And then from there, I figure out how much income I need to qualify for that mortgage. And if the Social Security and or pension income is not enough, but they have an IRA, and of course they have to have a required distribution from their IRA, I might have them increase that monthly distribution. And all we need is a letter from the financial advisor that I've increased the monthly distributions to this amount. And then the underwriter is able to use that for income.
Yeah, no, I think that's really helpful. And too, a lot of times, like until you're in retirement, I know that's a big transition from I'm getting my paycheck from my employer. And then once I'm retired, you're still getting a paycheck. It's just coming from different sources. And it might take 1, 2, or 3 sources to make up that same amount. So yeah, no, that's helpful. Okay. I guess, are there anything, so they qualify for the loan? Really the biggest piece in all of these is still income, right? It's income, what you have, what you're earning as to what you qualify for, right?
income and credit are the base. Yeah, yeah, and then of course job stability. So if you're going back off of retirees to get a mortgage, if you just started a job, you haven't worked in over 6 months. If you've been unemployed and you just started a brand new job and it's an hourly job or maybe even a commission job, then you might not qualify. Or you were on a salaried position and you decided to become a consultant, a 1099 consultant, then you're not going to qualify for 2 years. So it's really important to get pre-qualified before you start looking for a house or before you sell your house. I had a instance where a client, they're just so used to getting approved all the time that they sold their house and then they came to me for a mortgage, and I said, "Oops, you got a problem. You just started at 1099, so we have to take a 2-year average." So she was able to get hired as an employee, luckily. So we were able to save that deal.
Wow. So can we, let's touch on that a little bit. So someone who has a regular salary job, they've been employed, they're fine. And as long as you've been employed for how long in that position, your income will count and there's no issues.
So generally, you have to show that you've been employed for 2 years. You got to have a 2-year work history. It doesn't need to be exactly in that same line of work, but if you're switching from a salaried position to a commission job, then the commission we have to give the underwriters a good idea of what your income's going to be, and so they want to have a 2-year average on the commission income. If sometimes you get away with just 1 year of tax returns, findings will come back. So then, sometimes you get away that 2 years could be a little gray, but yeah. So you have to show job stability is the main thing.
Okay. So someone who has just made that change is now a consultant. They probably need to wait. How long is it going to be? That full year if they've just done that?
A minimum of 1 year, but ideally 2 years on a tax return.
Okay. So that person, essentially what happens is that their income is not going to be included in the mortgage. So if their spouse is working and has income, that's going to be the only income that could be used. It's just that person who's now changing because they don't have the 2-year history, they can't qualify with that possibly, right?
Right. Or they might have retirement funds that I could take a percentage of their retirement funds and use that as income. So that might work too. I mean, I've had people lose jobs before closings, and we were able to use alternate ways of calculating income.
Okay. I think it's helpful too, because, I think sometimes when we talk, it's kind of like, how can we get you to qualify for this mortgage? But I've got to believe that there are a lot of instances where people just don't qualify based on whatever factors, but maybe there's not as many, I don't know. Do you see that very much?
Yeah, actually, right now it's kind of going the opposite way. So we have all these programs that are giving grant money, or they don't have the loan level price adjustments because the income level is lower. I could actually drop someone off the loan if the person qualifies. One borrower qualifies on their own. They're both on the loan, but I could drop their income off and have them qualify for the lower rate and the down payment assistance, just because of the one person's qualifications. So where in the past it used to be family income, and actually there are some programs still that are still family income based, but
So changing gears a little bit, we've kind of been talking about what's changed in the last year, people in these specific situations. So we're going to catch a couple more here at the end of this episode. But I want to just touch on just something, that we have coming up is the election. Everybody's talking about it, is aware of it. So just, a general question I think that people have is, I have a mortgage. Will the election impact this? What is your response to that?
Well, I have a lot of people on the sidelines waiting to refinance, waiting to purchase a house, saying, I'm going to wait till after the elections because they're going to be lower interest rates. So I actually looked that one up myself, and I did find that 8 out of 11 of the last recent elections that the rates actually did come down after the elections. But the problem is the home prices went up too. So yeah, you may not really have gained anything.
Yeah. So people who already have a mortgage, they know they can refinance. This is kind of like what we said, lock in that lower rate of what you know today. And if they drop again, refinance again.
Right. And it doesn't matter which candidate really gets into office. They're saying, well, how will that affect mortgage rates? And it's really their policies. And if their policies create more inflation, inflation is what drives mortgage rates. So as inflation increases, they have to try to cap that by raising mortgage rates. So
yeah, no, that's helpful. Yeah, I think that's helpful even for people, just to put it in perspective of, the weight that we give things. But again, just helping our understanding and thinking through the decision of what should I do today, given things that are upcoming, things that we see ahead. So I guess one other, just with, elections and just people, that affect rates, I guess the Fed is, one of those groups in that. And so we hear, that the Fed in their meetings will probably start cutting rates. And again, we don't know like the amounts until they actually announce that at their meetings. But how does the Fed impact rates? And I guess when they start dropping rates or changing rates, is there kind of like this time period after which they announce a change or a cut in rates that then you start to see it in mortgages?
Sure. It always seems like rates increase quicker than they go down. So with the Fed lowering the interest rates, they're not directly tied to mortgage rates. It's the money that lenders could get, but the lenders set the mortgage price or mortgage rate. So the current anticipated Fed rate cut is already figured into our current rates because that's why we've dropped down. So if there is no surprise coming up with the Fed meeting, we're not going to see a change in rates. But if there's like a big surprise, then you're going to, one way or the other, you're going to see a change. But again, with the rates will go up much quicker than they ever come down. So there'll be and when you ask how quickly, it's really hard to tell because right now, we've seen this lowering over the last couple months, but it's I don't think there's a direct time correlation unless it's a big change, like when COVID happened and things were changing really rapidly, and so we saw big changes then.
Yeah, that helps though, even because like those, speaking to those people who are kind of waiting on the sidelines until after the election, it doesn't necessarily mean that after that in so many months, then you'll see this and this. It isn't that linear necessarily. So I think it's just helpful for people to even understand that. Yeah. All right. A couple more situations that have kind of come up. And so today we're kind of even just covering some of these like miscellaneous mortgage topics that, happen as life happens for people. And, we even get questions and have questions from clients of what do I do with my mortgage in these situations? So we're going to kind of talk about this. I think one of the biggest pieces though, as we've talked about, today, even in light of refinancing, buying a home, getting your first mortgage, is that the biggest piece is communicating with your mortgage lender. So someone like you where they can ask those questions, you can run a what if scenario and actually tell them what difference it's going to make before they act. And so I think that's one of the biggest things is be communicating, asking these questions so you know what you need to do, have to do, or can do, as you go. So I guess one of these next situations, I have a mortgage. What do I do if I get divorced? So what do I have to do? What can I do? The first question, I think, that kind of the scenario is one person wants to stay in the home, but the home has a mortgage. Can we keep that mortgage? Why don't you speak a little bit to that?
So divorce is it's a hard topic altogether, but it's best to get your loan officer involved just to help you know your options because everyone's situation is going to be different. And if you are a spouse that might have been a stay-at-home mom that hasn't worked in a number of years, and only income is going to be based off of what your maintenance or child support is going to be, then we need to know what that amount's going to be, and then we could kind of help you know if that's enough to cover your mortgage payment. And also, we need receipt of that. We have to show proof that you're getting that money. So we have to, at a minimum, have 3 months, which is a Wintrust guideline on our portfolio loans. But if we're going on a 30-year fix to Fannie or Freddie, then we need 6 months of receipt of that, along with the divorce decree or the signed marital settlement agreement. And then also, what's a good thing is that Fannie Mae will not count it as cash out if you need to buy out your spouse, like give them the equity, their half of the equity they're owed. So we would have, no matter what, you have to refinance that loan to remove a spouse off the obligation of the loan. And we could take that mortgage balance and then have a separate letter from an attorney how much that buyout needs to be. And that's basically kind of like a second mortgage note that's going to be shown on the settlement statement that it will pay off both. So you could go to a 95% loan to value and still be able to do that. It were cash out or standard cash out refinance, you could only go to 80% loan to value. So they give a little break that way. If the spouse is buying their own house prior to this current loan being refinanced, we can take the court order, the divorce decree, showing that the responsibility is on the other spouse for that loan, and not include that housing payment in that person's. So it might be a case where it just makes sense to sell the house because the spouse can't afford it, or the one spouse wants to stay in the house that's making all the money. So they would do a cash out refi to pay off the exiting spouse.
Okay. Yeah. So really depending kind of who needs to stay in the home, who it is that's wanting to stay in. I think it's interesting though, once that divorce is kind of finalized and you have the divorce decree or you have that settlement, and knowing what you're going to be receiving as maintenance payments or child support, pieces like that. I think that's helpful to know that, if you haven't been working, that those amounts can count towards a mortgage payment, especially someone who has a low mortgage balance, versus the value of the home, they actually might still be able to stay in it. So I think that's really helpful.
Right. It's really important to make sure the spouse is off your mortgage though, because if they stop paying, the other stops paying the mortgage, that could affect your credit scores. So you definitely want to make sure you're off of the loan.
Yeah. So if your name's on a mortgage, technically you're still responsible for the payment of that mortgage. So yeah, even if you kind of have a handshake agreement of, well, the other spouse was going to make those payments and wanted to stay in the house, it doesn't matter. You need to make sure that that's actually documented and updated.
I've seen it many times where just the credits get destroyed from divorces, unfortunately.
Mm-hmm. Yeah. Okay. So we're going to kind of switch. Another situation that we've seen or heard from people before is there's a mortgage on a home. The parents live in the home, and then there's children that live with them, but more like adult children. So this is think someone who's maybe in their early 20s, maybe still in college or finished, but not quite launched yet. So they don't have that full-time job. They're still living at home. Both of the parents pass away suddenly. So now the two children, adult children, are left in the home. One of them is earning income, so they can still make that mortgage payment. I guess when someone passes away and you're still wanting to stay in the home because they couldn't, afford to go somewhere else, what should they do? What are they required to do? Any guidance on kind of what someone in that situation where they should start?
Sure. Well, they should start with contacting the loan servicer is probably the correct answer. I've seen many people just keep making the mortgage payment, and the mortgage company really doesn't know. But there is a federal law that I found that requires lenders in this sort of situation that inherit a property. It's called the Garn-St. Germain Act. So someone could kind of look up that before they contact their lender. But the lender is going to the servicer is going to want to basically take qualifications. That you still have to have your debt to income in line to be able to qualify for the loan. But generally, they will then assign the loan over to you, and then you have to provide the death certificate to get the titles situated, so you get your name added to the title and the deceased person off the title. So.
Mm-hmm. Okay. And I think there's a few pieces there, moving pieces of so the parents, if their names are on the mortgage, but whose names are on the title, who is supposed to inherit the property. So kind of knowing and making sure that you're the person that's supposed to inherit the property. Okay, I can stay in it, or I want, to choose to. I think that's important to kind of maybe know a lot of that information. It's kind of sometimes I think when something happens like this, someone passes away and we're trying to figure out, like, what do I need to handle first? What do I need to take care of? And a lot of times, even if you want to start to retitle accounts in your name, because you're the beneficiary, even if it's a spouse, there are things that you have to wait on, like a death certificate, to actually be able to do something. So I think that's just a good amount of time, whether that's 30, 45 days, from the actual date of death. I think this is helpful for people to understand kind of getting the pieces of information in place that you need before, you kind of go to some of these sources to say, okay, what do I need? What can I do? Some of those questions like that.
Right. And I see more of the estates selling the houses. So when I have a buyer that's purchasing a house from a deceased estate, we have to have proof that the person selling the house has got, is legally able to sell the house. So we always, so they usually provide the will or the paperwork that shows that this person is acting on the behalf of the estate.
Yeah. So whether that's maybe, like you said, the will, maybe the trust agreement.
The trust agreement.
Yeah, that's helpful. Mm-hmm. Okay. So I guess any other scenarios that you've come across, recently where you're just thinking, wow, this is kind of uncommon, or, people may not know about this. Anything that, people should know, kind of in closing, just any thoughts you feel like people would benefit from hearing?
Right now, it seems mostly make sure you don't qualify or would qualify for any free money that's out there. So ask about down payment assistance. Ask about first-time homebuyer, any kind of credits for that. And a definition of a first-time homebuyer is anyone that hasn't owned a home in the last 3 years. So you could actually have owned a home before. So just don't let someone just pigeonhole you into a product and say this is one for you. Make sure you get a lot of options. Right now, people come to me and say, I want an ARM, fixed term rate ARM, adjustable rate mortgages ARM, and they think that that's a lower rate. In the past, it used to be a lower rate, but that is a different index, and we have an inverted index right now. So the ARMs are actually higher than the fixed rates right now. So there's not a lot of product choices that we could offer right now, it seems like, but everybody's situation is going to be different, because if you have a low FICO score and you're looking at a condo and you have minimum down, that's like the worst case scenario on what your rate's going to be. But if you got a high credit score and you're purchasing a single family house and it's your primary residence, then you're going to get the very best. So people, they just listen on the radio ads what interest rates are at, and they think that that's what they're going to be getting. Well, everyone's different, so you only hear advertisement on the best case scenario. So you want to make sure you know all your options.
Yeah, I did think of one other point that I did want to ask you about. It kind of has reference back to that person who's purchased a home within the last 15 months. If someone has purchased, let's say it's only been, within the last 12 months, is there anything that you've seen commonly like built into that mortgage agreement where if they refinance within 12 months that there's no closing costs, anything like that they should be asking about?
Yeah, so that's loan officers will say, well, if you come to me, there'll be a free refinance whenever, well, there is no such thing as a free refinance. The cost is still going to be the cost each time. What you're doing, you're building it into the interest rate that you're getting. So, it might be reduced cost because you don't need an appraisal or you're working with a good title company that's giving you a great price on title, which we do right now. And it's, we're customers on a refinance are paying probably $525, where when they purchase the house, they're paying $4,000. So it is a lot less in closing costs on a refinance than a purchase. So it goes back to, what is that savings per month, and yeah, if you have a small loan amount, that's going to be really difficult to get the lowest rate on a refinance and pay your cost. It just might not even be able to happen.
I think this has been really helpful. Another chance, anything else you can think of that you've seen, or is that pretty much it?
Yeah, just don't get too discouraged. I have a lot of people that's been looking for a long time, and then they end up just signing a lease for another year. And so work with your landlord, see if you could go on a month-to-month, or you don't have to be tied to your apartment if something nice comes along.
Okay. No, this is great. It's always helpful when we kind of just update things, even though it's been a year, rates change so much, and not always, but in the last few years, they definitely have. So I think this is really helpful for people kind of just navigating what should I do with my mortgage. Well, thank you, Tom. Thank you for joining us.
Thank you, Michelle.
We appreciate you listening. If you're someone who's trying to make the most of your mortgage for the good of your finances, you don't have to go it alone. There are professionals like Tom or like our team who are here to come alongside you and bring confidence to those decisions. You can reach out to his team or to us, and we'll include all of those links in the show notes. And until next time, we will talk to you on the next episode.
Thanks for listening. To find any links or resources related to this episode, check out our show notes. Your host was Michelle Smallenberger, a certified financial planner and CEO. The guests featured are from Financial Design Studio, a team of experienced, fiduciary, fee-only advisors based in Chicago. Anna Lewis is the executive producer of the Behind the Designs podcast. And as always, for more information about Financial Design Studio and who we are, check out our website, financialdesignstudio.com. And final note, no content discussed on this podcast should be taken as financial advice. Financial Design Studio accepts no responsibility for your individual choices. We'll see you in the next episode.